Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most? And do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right, no extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
All right, welcome to The Wealth Flow. My guest today is Ryan Carriere. He is a tax strategist at Hall CPA. He has worked with hundreds of real estate investors, helping them reduce their tax liabilities with tax strategies that align with their goals and with their portfolio. So, Ryan, welcome to The Wealth Flow.
Thank you for having me.
Yeah, as we were talking ahead of the show, I had mentioned that you were the first CPA for us to have on, and so I'm really looking forward to this conversation. If we could maybe start just though with where you grew up and what eventually led you to become a CPA and one that specializes in real estate strategies.
Yeah, I'll try to keep this short. So I live and grew up in Minnesota. Kind of in the suburbs of Minnesota. So went to college at the University of St. Thomas, which is in St. Paul, Minnesota. I think it's the largest private college in Minnesota. While I was there, kind of going into college, I kind of knew business of some sort. I didn't know if it was like marketing or kind of accounting, finance. Ended up getting a double major in accounting and finance, kind of sticking with the numbers. Both of my parents are kind of numbers people. My mom's an actuary, my dad's an engineer, that kind of stuff. So fit right into kind of the numbers mindset. And from there, I went to work for Honeywell and basically went into kind of a more normal corporate accounting role. While I was there, got my CPA after doing that, and then transitioned into actually working for a CPA firm, deciding I wanted to get out of corporate and kind of do more of the public accounting, kind of taxes, audits, things like that. So I started working for a small CPA firm here. When you're working at a small CPA firm, you're doing a little bit of everything. So you're doing some accounting, bookkeeping, you're doing some like audits of financial statements, and you're doing tax returns. And so while I was there for just over 3 years, almost 4, was doing kind of a lot of everything there, decided that I basically bought my first rental property back in 2017. It was a single family home, and it was bought 50-50 with one of my buddies. And we did kind of the house hack.
Right.
If I don't know if your audience is how familiar they are with that. But me and my buddy bought it. We lived in the basement and we rented out the upstairs. I think he and I lived there. He was a little bit longer, but like 1.5 years, 2 years. And then I got married, and then he got married and moved and all those things. And now it's we still hold it. But while I bought that, I at the same time was starting to listen to Bigger Pockets. And again, I don't know how much your audience is familiar with that, but Bigger Pockets, big podcast, for real estate investors and whatnot. So I was listening to that, kind of got me into real estate, the interest, and then I'm still a CPA. And basically, while I was at that smaller firm, kind of decided, is there a way I can mix these two? Can I be a CPA and can I bring in real estate investing? And so then it became, okay, how can I do that? And what is the service that these real estate investors are looking for? Audits, financial statement audits within, real estate investors is very minimal. Only the really, really big players. And so I kind of switched into, I just want to do taxes for real estate investors. And so at that point, I then moved over to a larger CPA firm, was there for about 1.5 years and got really good exposure, really good experience just doing large partnerships and really high income, really high net worth individuals, just the tax returns, those annual beloved tax returns that we all have to do every year. So I jumped into that for about a year and a half, really good exposure. And then basically some time after that, there was a kind of job opening, which I'm currently in as a senior advisor at Hall CPA, also known as the real estate CPA. And so jumped into that, and I've been there doing this for about 2.5 years. I love it, and it's very fun being able to kind of consult and provide strategies and savings on a very proactive basis to my clients. I will just say one of my clients has been a guest on your podcast here. I won't say who that is, but basically, this is what I do, right? So I help clients working through helping them understand where are the tax savings, what strategies, when. Oftentimes, timing is the right thing as far as when to use these things. But yeah, just kind of this combination of, hey, I'm a CPA and I like real estate investing and I want to combine the two. And so there's just kind of this path where they just completely have crossed at this point, and that's kind of led me to today.
Yeah, that's great. Well, before we get into the additional CPA stuff, how about just maybe for the audience, explain what you mean by house hack? I'm familiar with it. Familiar, obviously, with the Bigger Pockets as well, and certainly have burned through many of episodes of theirs and learned a lot. But house hacking is something I had done before I'd heard the term through a triplex that I had bought. But I'd love to just kind of maybe have you tell the audience a little bit about what you did there.
Yeah. So bought the house just like you would, a normal house. It was meant to be a primary residence. I think we did 5% down. And it was 2017, so interest rates were really good. I think we got like a 4%, 4.25% interest rate, which was fantastic. But essentially the house hack is, hey, I'm going to go buy a home, but I'm going to rent out the extra space. And so for a single family, it's basically renting out extra rooms. And so me and my buddy, like I said, lived in the basement, and then we just rented out the upstairs. So it was all friends, which made it easy. So it was like, hey, buddies and kind of like roommates, except for we own the house, right? Another really good example, you just mentioned a triplex, that works too. It doesn't have to be just single family. This could be multifamily, but you live in, say, in triplex, right? You live in one unit and you rent out the other two. Same thing with the duplex type idea. But basically, it's your home, and being your primary residence allows you to get a much lower down payment. If you're using, FHA, 3.5%, 5%, 10%, it just allows more flexibility and a higher potential cash on cash, because you're making a much lower percentage down, 5% compared to 20, 25%. So that kind of lower investment gets you going faster into the realm. And so that was really key, not only to just get going and, hey, I bought a piece of real estate, but also now all the debt pay down, the appreciation, right? We could talk about tax savings, the cash flow, all of that. But it's really just buying a home and then essentially renting out the extra units or rooms, depending on your situation.
Okay. No, that's great. Great explanation there. And right now, is it currently being leased as just one unit, or do you have somebody living in the basement like you guys did?
All one unit. So it's just one lease, and it's traditionally the last few years, either it's by the University of Minnesota,
Cool.
that campus. So it's usually been like, some college students or like young professionals who have just graduated. But it's a really good kind of growing area, so close to Minneapolis and the U of M. But yeah, it's been good for us.
Cool. All right. Well, yeah, if you could tell us just a little bit about, when I think of real estate and taxes, I think, of course, of depreciation, and maybe you could just kind of explain that to the audience as well. There may be some folks that don't currently take depreciation. I'm sure they do if they've got something to be able to do that on. But explain how that typically works. And then, of course, I want to hear about accelerated depreciation and, doing a cost segregation study as well.
Yeah. So I'll try to lay some of the foundation and context before I dive into, kind of depreciation and some of these strategies. I always find this is the best place to start. So the biggest, context and historical context to diving into this is back in 1986, there was a large tax reform act that came out, and essentially the main thing for real estate investors was that they said, hey, rental properties are no longer just by default considered non-passive, like you would think your W-2 income is non-passive. You would think your business profits, if you're a business owner, is non-passive, or portfolio income, like, capital gains from stocks or dividends. Basically, they said rental properties are going to be kind of split out and taken out. And now we've got this kind of new category. And again, the key word here is by default, right? So by default, rental properties are considered passive. And so with that kind of distinction first, they have this rule where they've said, okay, non-passive income, again, for those of you listening, that's kind of your W-2 or business profits primarily. That income can really only be offset by other non-passive losses, right? And so the default then is, well, rental properties are passive. Well, that's now the dilemma, right? And so the rental property losses, which you're normally going to get because of just normal depreciation, depreciation is going to start to offset some of that normal cash flow or net operating income. Now you're going to show a taxable loss, okay? But that's not going to allow you to offset that W-2 business profit. However, within that, they years later started to put in some exceptions because there's probably some lobbying and some people pushing back on that and so forth. And so what they said is, well, okay, you can't do this, if you make so much in income, okay? However, the exceptions then became later on, just a couple of years later, real estate professional status being one of them. And we'll talk about that next. But the other main exception, as we think about rental properties being passive and moving them non-passive, would also be the short-term rental strategy. So thinking vacation rentals, Airbnbs, VRBOs, we can get into that second. But that was now the two exceptions to kind of move those, what would normally be passive losses, to the non-passive side. Okay, now great, right? We've got your W-2 business profits, that's income. And now if we've met something like real estate professional status or the short-term rental strategy, now we've got some non-passive losses from your rental properties, okay? So now they're both non-passive, and in short, with a few other major exceptions that we probably won't talk about for today to keep it simple, this income and loss can now offset each other, right? So that's great. So, right, I'm just trying to kind of illustrate the context and the exceptions here of real estate professional status and the short-term rental strategy. So now let's kind of move into what is the real estate professional status. And we kind of simplify it. If you're following any of our content, we call it REPS, REPS. It's kind of the acronym that we use. So real estate professional status, or REPS, kind of three main components to it. It's really two steps. But the first step I break out into kind of a part A and a part B. So part A of step one is that you would meet 750 hours in a real property trade or business. Okay. So just for perspective, 750 hours, you've got a full year to do that, let's say. That's about 15 hours a week. Okay. And the real estate businesses are going to be things like you're a realtor, you're a broker, maybe you own a property management company, or maybe you're in full-blown, hey, we build new properties, okay? New construction, something like that. So those are real property trades or businesses, okay? But the second part B of step one still, is that you need to have more than 50% of your working time also in a real property trade or business, okay? So right there, that test takes out people like me. Because I work a full-time W-2 job, it's going to be essentially impossible, according to the IRS, for me to now go spend another 40 hours a week getting more than that 2,000 hours in just real estate, right? So they know that. But you might be full-time in real estate. You might have some people listening who are realtors, right? Or brokers, and they might say, oh, can I do this? Yeah, most likely. It sounds like we can potentially meet step one, okay? But then we go to kind of what I'd call step two, okay? So step two is then material participation in your long-term rental properties, okay? We're going to get to short-term rentals in a second, so hold tight on that. If you're like, oh, I've got this mix of long-terms and short-terms, we're just kind of focusing on long-term rentals. And that can include commercial properties. That can include warehouses, big apartment buildings, a single-family home. As long as you've got, essentially a 12-month lease, I'll kind of distinguish that in a second. We're talking about long-term rentals. And so there are 7 material participation test options. The two main ones that I'll break it down just for the sake of time is that you would accumulate a minimum of 100 hours and your time would be more than anyone else. That's one main option. And option number two, the primary one here, again, there's 7, but this is another common one, is that you would accumulate at least 500 hours in your long-term rental properties. Okay. So again, there's 7 options. Those are kind of the most common 2 that I'll just bring up for the sake of our time today. Okay. So very, common if you're a realtor. Okay. And I get this question a lot. Hey, what if I'm a realtor? Don't I automatically meet real estate professional status? And it's like, hold on. How much time do you spend in your rental properties? And they're like, oh, I just have a property manager. I don't do anything. So then I'm like, how are you getting material participation in your long-term rentals? And generally the answer is they're not, right? So there's a lot of misconception out there, and people forget, hey, I'm in real estate, therefore I qualify. No, not necessarily, right? You've got to actually put in time into your rental properties, and you have to meet one of those tests that I said, 100 hours and more than anyone else, or the 500-hour test. Again, it's just options, okay? So now, just for context, again, if we've met 750 hours, more than half our time in real estate, and we've met, say, that 500-hour test, congratulations, we've checked all the boxes, we meet real estate professional status. And now, again, what that's going to mean is all of our long-term rentals are no longer passive, and now they're considered non-passive, right? So great, now we've met that. Step 2 as we move forward is, well, okay, great. If I'm in a year where I've met this, my goal should be I maximize the heck out of all my losses I can. So in steps a cost segregation study, right? Because now we can be looking at things like accelerating depreciation, right? Taking that depreciation from the future, maybe it would have normally been depreciated over 27 and a half years. And now we're moving a huge chunk of that into the current year, right? That we've met real estate professional status. That's great. So I can move into that next, but I don't know if you want me to just kind of pause if you've got any questions there, but I could just move into cost segregation studies if you want.
Well, I would like to ask a couple more questions on that.
Yeah.
So you have to have the 750 hours, but then you kind of mentioned that there is sort of a caveat with that. It also needs to be at least half of your time. If I have a W-2, but I'm a real estate broker, I, work outside of that W-2 on the rental properties, is the fact that I've got a 9-to-5 W-2 job automatically going to be raising questions and saying, yeah, you're probably not going to be able to qualify? And if so, is there a way, if that is an issue, is that something, if I document it, I would have, the ability to, at least if I do get audited, be able to show that? Or what are your thoughts there? Is it pretty dicey if you have a W-2 like yourself? I mean, yeah, obviously I look at my own self, and I'm not currently claiming real estate professional status. Let me get that out there. But I do spend a ton of time with my properties. So we specialize in mobile home parks, and got short-term rental, and I have a brokerage that I've had for years, since like 2000. So, but anyway, what any thoughts there? I guess just want to verify, if I've got a W-2, I'm kind of screwed as far as that side of things go.
Yeah, it's going to be really hard to justify that. So for someone like that, it's going to be considering, hey, should I move to part-time? As in, like, I'm getting paid 30 hours a week or 25 or 20. That kind of data point is now going to say, hey, now we've got a much better chance and opportunity where I can more easily, just even on the front end, justify, hey, I only work 20 hours here, then I can get 25 hours in real estate, right? That seems way more realistic, rather than, again, if you say, hey, I got 40 hours a week, call it 2,000 hours a year in your W-2 job. Okay, that's generally not going to qualify for real estate, trade, or business, the 750 more than half your time. You then have to show literally 2,001 hours just in your real estate, right?
Yeah.
That's just so unrealistic, unless you're, right, kind of doing that way more part-time, right? It's just very unrealistic, and the IRS knows that. So I will say, from what I've seen and things that I've heard, just kind of being in the position I'm in, generally, if we have 1 or 2 W-2 people, say husband, wife, right, we show 2 W-2s on your tax return.
Mhm.
And then we try to claim real estate professional status with 1, 2, 3, 4, 5 properties, even a large portfolio. The IRS is generally going to scrutinize that. They're going to say, yeah, probably not, right? So you're just a good target for them and an easy target. So we just want to be very careful on that, especially
Yeah.
for that situation.
Yeah. So, and then just go into the kind of the next deal. You'd mentioned the material participation side of things, and it is interesting. There is a lot of misconceptions out there. You think, I've heard constantly. You have a high paid individual, doctor, attorney, whatever it may be, and then the wife just gets her real estate license, and all of a sudden they can claim that and offset his or her income, depending on who has the high paying job. But what I'm hearing is that's really not the case. There needs to be that material participation, and most of the time they're not really managing their portfolio.
Correct. So let me talk about that because that can be a strategy. However, the issue that is really frustrating as a CPA who does this all the time
Mhm.
is we constantly hear, hey, if I just go get my realtor license, I qualify. And I would
Right.
just go back to them and say, where does it say that in the tax code, right? Just because you get your license, that has zero to do with hours that you've spent in your real estate or being in a real estate business, right? Literally everything I've said is 750 hours, more than half your time, and then a big chunk of time in your rentals. That had nothing to do with being a realtor.
Right. Yeah.
You simply getting some sort of credential or whatever, that would be nice. Literally everyone would do that. Like if that were the case, it's also similar to me when I hear people say like, I'm just going to go get an LLC and set one up and I'll get all these deductions. Don't you think every tax strategist would literally just set up a bunch of LLCs and write off all of their family's no, like it's just ridiculous. So it's frustrating to me when I hear these things on TikTok and whatnot. It's just frustrating. But the other thing I'll comment on, so say like I'm married and my wife is staying home with our son. Right now we have a second one on the way, due in August. We're very excited. But she could, claim and meet the 750 hours more than half her time. She has no other competing work other than being a mom. But that time being a mom is not paid services, as in providing a service to someone else. So we as a family are in a fantastic position to meet the first step, 750 hours more than half our time. However, we still need to get time into our rental properties. And we currently have property managers. And here's the thing. She wants to spend zero time additionally in our rental properties. So it just doesn't work, right? There's people out there who are doing what I say, they're letting the tail wag the dog, right?
Mhm.
They're letting tax savings drive all their decision making. And what I found after just being in the position I've been for a couple of years, people generally regret that or they resent their partner who pushes them into doing it. Okay. So please don't do that. Your tax savings, which are simply dollars, right, are not worth the resentment, frustration, getting into a bad investment, all of those bigger picture things. Let the tax savings be the icing on the cake, right? That's kind of how I see it, kind of philosophically, if we want to call it that. But going back as well, as far as time in the rental properties or the 750 more than half your time, you do need to have a time log. And this is another big issue or misconception. People think, I can just claim it. I think I'm close enough. Really? If you go under an audit, they're going to say, prove it. And just a comment I'll make, the tax court cases are very different from a criminal court case. Okay. Criminal court case, I'm not an attorney, but just from what I've learned, you are innocent until proven guilty, right?
Right.
By that lawyer. However, in a tax court case, it is the complete opposite. So you are guilty of whatever they're questioning, and you have to prove them otherwise. So you know what happens usually when people lose in court cases? You got 2 W-2 people trying to claim reps with a couple rental properties. They say, hey, we don't think so. Here's your audit letter. And they go, no. And then they're scrambling. Okay, they're freaking out. They're trying to call their CPA. Their CPA is like, you told me this and blah, blah, blah. I just claimed it. And they're like, oh, shoot. And so now the IRS agent is going to usually question them, go through a series of questionnaire things. And then they're going to say something like, send us your time log. Because everything's about time, right?
Yeah.
Everything is about time there. 750 hours, more than half your time, 100 hours and more than anyone else, right? Something like that. And so now they're scrambling. And just to comment on this, the audit is going to be years later. Okay. This isn't like, oh, you submit your tax return and boom, you get a letter the next day. This is like 3, maybe 4 or 5 years later. Okay. So when they question you and they say, hey, send us your time log to prove that you met real estate professional status, and you're like, hey, I'll get back to you. They write that down and they say, did not have your or did not have their time log ready. And so now you look illegitimate. You look like you don't have documentation to support that. And now they're going to let the judge know that if it ever gets to that point, right? So you not being prepared, not having a time log puts you at risk. So one of our kind of defaults for our firm when clients are going to say, hey, we're going to claim this or that, we say, great, send us your time log. We will look at it first. If we don't feel comfortable, we are going to basically have a conversation and say, we don't think this is going to be appropriate, and make decisions from there. So we are going to look at that. 95% of other CPA firms are not going to do that because they don't care, right? They're just going to say, oh, we don't understand real estate. This is probably not a big deal if we claim it. Are you kidding? This is like one of the highest audited strategies in America, as far as I'm concerned. So it's huge. It's a huge importance to actually get that documentation and have that in your back pocket ready to go. So I'll pause there. I know I was talking a lot, maybe rambling a little bit, but
no. Very, very interesting, and some great points for sure. Yeah, you got to think through those things. Absolutely. You may be going to the short-term rental strategy after cost segregation, but if not, I definitely have a question on the short-term rental piece of the puzzle. But you want to maybe go into cost segregation first?
Yeah. So let's assume that you've met real estate professional status. That to me, as a CPA kind of tax strategist, that becomes a little bit of a no-brainer as far as really considering doing a cost segregation study. Okay. So that's one of the main triggers. Hey, I've met this. Okay, fantastic. Let's go evaluate with a CPA. Does this make sense for this property or that property or that property? There's so much to consider. What was the year that it was acquired? What was the year that it was placed in service? How much of it was building versus land? What was the type of property? All these things to consider. And we as a CPA can help you think through these things. But just to kind of start with some basics, assuming that we've said, yes, let's move forward. All right. So just to answer the question, what is a cost segregation study? Maybe a lot of your audience is familiar. And then why is it important, especially from a tax perspective? And it really is, at least to me, primarily a tax strategy. Okay. Mm-hmm. But what it is, right? Real simple. Essentially, it's, imagine we've got this, call it a fourplex, right? Maybe you've got, when you first buy it, you say, hey, we've got 80% of our costs, call it $1 million of a purchase. You've got 800,000 of that going to be depreciated as our building. Okay. For building residential, you are going to depreciate that 800 grand over 27 and a half years, simply straight line. Okay. So you're literally just going to take 800 grand divided by 27 and a half. That is your depreciation for almost the next 30 years. Excuse me. And then the land we can't depreciate, right? And a lot of people know that. However, you stop there if you don't do a cost segregation study. Okay. If you do a cost segregation study, though, what's really within that building and what the engineer company, the cost segregation study company is going to help you with is really you've got what us in the tax world would call personal property and land improvements. Okay. So now if we do this study, and I'll kind of talk about the land improvements, things like that in just a second, but really what we've got is now faster depreciable life. And what the study is going to do is it's going to move some of that 800 grand now into the 5-year property and some of that into the 15-year property. And a lot of you might be then questioning, well, how much? Well, that's what the study is doing. But generally for a residential property, it's between 20 to 30% of the building. Right? So that 800 grand, what is that? 25% of that is 200 grand, I think, if I'm doing my math right. I'm a CPA, I'm a tax person, but mental math is not always my best thing. So double check always. But let's now assume we've taken 200 grand and now we've kind of split that into the 5 and 15-year property. That's great. Okay. And at the end of the day, that's what the study is doing. It's kind of helping us move things into these two categories. So what are they? All right. So 5-year property, for example, would be things like your cabinets, your countertops, your appliances, your light fixtures, there's a long list. Okay. So now we've got some of that cost moved into there. Great. And then we've got 15-year property, right? That's the land improvements. And so, for example, that would be things like driveways, sidewalks, decks. Maybe you've got a pool. You've got maybe a big, nice apartment building, something like that. Those would be things that are now 15-year property. And most of that 200 grand is going to go to the 5-year property, just in generality. Okay. So that's great. That's what the study's doing. But why is that important? That's important, especially as we're still under some of the Depreciation Tax Cuts and Jobs Act's rules, because what they've given us is anything with a IRS life less than 20 years, right, are now 5 and 15-year property is eligible for that bonus depreciation, that accelerated depreciation now that we can take. That's fantastic, right? And so from 28, I'll keep it simple, but from 2018 property placed in service to 2022, we've been able to accelerate 100% of that property that has a life less than 20 years. And where we're at in 2023 and 2024 is we're currently in kind of a phasing down of the bonus depreciation that we can take. So for example, starting in assets placed in service in 2023, now we can't take 100%. Now it's actually only 80%. So every year moving forward, so we're in 2024, now we're at 60%. Once we get to 2027, we're going to be at 0%. Okay. Unless the tax law changes, and there have been things that have moved from the House and now with the Senate, and it doesn't seem like things are going to be moving anytime soon. But basically, the tax bill has to change for this kind of rephasing out, maybe to come back to 100% bonus. And that would be huge for real estate investors if that becomes a thing for tax purposes, right? So that's essentially what it does, right? The kind of breaking out into now the 5 and 15-year property. Why it's important is because now we've got this additional acceleration of depreciation into the now, instead of having to take all that depreciation over the course of 27 and a half years. So moving deductions into the now, instead of having to wait into the future, that's just the time value of money theory, right? Because now what you're going to do is take those dollars of deduction, right, through depreciation, and now you're going to generate more of a tax refund or less tax payments in, right? And now you're going to keep more dollars in your pocket today. What are you going to do with that? Well, hopefully you don't go buy like a Lamborghini or a yacht, right? Hopefully you take this tax savings and you go reinvest this into an investment, right? Now to earn 5, 10, 15%, whatever it's going to be, whatever you're comfortable with. And now you've got those dollars, those extra dollars working hard for you. So that's kind of the short of it, kind of what it is, why it is. I'll pause here if you want me to dive into anything else further on that.
No, not necessarily. Obviously, you can see if you, in the $200,000 example, if you're able to take a good piece of that 800 and bring it all the way up to 5 years, obviously that just increases the amount that you're able to deduct each year, even without the bonus depreciation aspect of things. Just by having the cost segregation study done, it already increases the depreciation that you'll be taking each year. And then one thing I do, maybe want to have you touch on is just, because I didn't know this until just recently, but I guess it's when you buy the property, right? So I'm thinking of a mobile home park that we haven't done one on, and it's just out there, but it was back when it was 100% bonus depreciation. So because I purchased it back then, am I able to, if I do a cost segregation study, say today, still get the 100% bonus depreciation?
Yeah. So let's say it was acquired and then placed in service in 2022. We'll just call it simple. Great. That was the last year for 100% bonus depreciation. So let's say now you're looking at your 2024 tax return. You could do that. You could still get that 100%. You've been depreciating it since 2022 and 2023. So you've taken a little bit so far. So the unique thing that you'll have to think about is, well, I need to file Form 3115. It's an additional form you'll include with your tax return to tell the IRS, hey, I've been depreciating this property like this, 2022, 2023. But now IRS, you're kind of raising your hand a little bit. And now I'm changing the method to calculate my depreciation because we've got this new study done, right? And so now on your 2024 return, you can essentially catch up on the depreciation that you could have taken, but now you're really taking in 2024. I will just tell you, for the sake of time, there is a ton of strategy because there's a lot of timing that can go into that, right? Because Keith, what if next year you're like, hey, I'm going to meet real estate professional status? Well, guess what? You're just going to wait another year. right?
Yeah. Yeah.
You're not going to do it this year because you might say, hey, and now I've got this tool, I've got Form 3115, I've still got this 100% kind of depreciation deductions that I can accelerate. It's almost like you've got this thing in your back pocket that you can pull out anytime,
Yeah.
right? So you've got kind of this weapon or whatever you want to call it as far as like an option for you, really. So there's a lot of timing that goes into that. And that's why clients come to us is to say, hey, I've got these things going on. This is going to change this year. What year is the best? Should I do it now? Should I amend prior year's tax return because this happened, or do I look forward? So a lot of strategy comes within timing with these tools.
Right. And yeah, no, great point there. And then, one thing I was going to ask you a little further down the road, and I don't want us to forget about the short-term rental strategy, but before we go there, just kind of talking about having this weapon or this thing that you can kind of keep in the background. Let's say I am the W-2 professional that I am, right? But I've got a property that I'm selling at a significant gain, and now I've got that property that I haven't done the bonus depreciation on. Now this might be a good year for me to be able to pull that card out and say, okay, the sale's happening. I normally at the end of this year would have to pay the capital gains tax, but if I utilize this in the same year, I'm able to kind of wash away or at least reduce the amount that I would have to pay from a capital gain standpoint. Is that correct?
That's correct. Yep. So that's a fantastic strategy. That's another really good kind of no-brainer time to consider if this is the right year to do a cost seg. So absolutely, some people might call that like the 1031 exchange light. In your example, you're not necessarily buying a new thing as you would think with the 1031 exchange,
Right.
But you've basically got these losses that you can access in order to offset that gain that you're going to recognize. So absolutely, we've got lots of strategies. Again, that's part of the timing that we talk about with clients. Hey, let's do this cost seg on this property this year, this one next year, because this is going to happen. So much to consider, but yes, to answer your question and keep it short, absolutely.
Do they look at the strategizing? A lot of people think, oh, once a year, I'm going to push all my stuff over to the CPA. But, as you mentioned, there is a planning aspect of things. And, as different parts are moving, it's probably good to continue that conversation with your CPA along the way.
Yeah. I will just say there's two different types of kind of tax people in the world. There's tax preparers, those who will file your tax return, and there's tax strategists. Okay. A lot of people don't necessarily need to have both. You got to have at least one. And maybe you're the tax preparer if you're filing your own tax return on TurboTax, right? But at the end of the day, there's a lot of people, and especially those who start to buy rental properties or businesses, that is going to start to trigger a need for a tax strategist. How can I be more efficient, if anything? And guess what? The higher the income you go, the more necessary that is. Okay. It's wild to me that I have people who come to me in, making millions of dollars, million plus, and they're in the 37% tax bracket. They're filing their own tax return, which I just find insane for the dollar per hour work that they're doing. And then they also, for the first time, are getting a strategist. It's like we should have been working years ago together with you, right? We could have had years, tens of thousands, hundreds of thousands of dollars of savings at this point had you started working with us years ago. So I just wanted to primarily comment tax preparer, tax strategist. Make sure you understand the difference. Tax preparer, file your tax return, tax strategist, helping you think through how can we save on taxes based on our situation, based on our goals, and based on what we want to buy.
Okay. What about the short-term rental?
Yeah. I appreciate you continuing to bring that up. So the short-term rental, just again for context, right? That is very similar in what real estate professional status does by now moving what would normally be a short-term rental passive loss, now being kind of transferred over to our non-passive loss, right? So just for context, okay, what is this doing? So here, let's just kind of walk through the requirements. So again, 2 steps. They're actually much simpler compared to real estate professional status. But the first step is that the average stay per guest at said property is 7 days or less. Okay. Very, very, very common for vacation rentals, Airbnbs, VRBOs, generally kind of weekend stays, right? So that's the first step. Okay. That's it. How is it used? Do you have an average stay per guest less than 7? And I will just comment, it is 7.000000, right? You get the point. So it can't be, 7.1, does that qualify? No, it doesn't. Okay. But then the other comment I'll say is you need to have a minimum of 2 stays. Okay. I have had clients come to me and they will say things like, hey, we had a short-term rental, blah, blah, blah. It was, placed in service, simply meaning we finished the renovation. And then I'll say, great, can you send me all the stays that you had to show me your average? And they'll say, I didn't have any stays. And I would just say, well, what's your average? It doesn't exist, right? And so we have to be very careful that we actually get some stays, especially if you're listening to this towards the end of the year. And you're like, I'm going to go implement this right at the end of the year. Okay, if you buy that property December 31st, this is likely not going to work because you're not going to probably get a stay. Okay,
Right.
so we got to be very careful about that. But then let's talk about step 2, right? So step 1, average stay less than 7. Step 2 is the same material participation test options. So I'm not going to walk through the 2, but right, it's the 100 hours more than anyone else or 500 hours. Okay, so that's the requirements. 2 steps, 7 days, and then material participation. It's the same test I talked about on real estate professional status. Simply the difference is that you are then only looking at your short-term rentals. That's it. Okay, so if we've got a bifurcation in your portfolio, we've got maybe mobile home parks over here, we've got short-term rentals over here. We have to split them up separately as far as, okay, can they both be considered non-passive? Okay, but here's the main comment that I just love to talk about with, for example, my clients. The short-term rental strategy does not require 750 hours or more than half your time in real estate. That comment right there is why most people who come to us, most people who have a W-2, most people who are full-time working in business, their business, that is why they use that strategy. Okay? Because the barrier to entry for a lot of people is they need to simply like more than 100 hours. Okay? I will tell you, I've seen this so many times. So here's a good example. New client, they live in Minnesota, they go buy a short-term rental in Florida. Okay? They buy it towards the end of the year, they get like 3 stays all weekends in December. Fantastic. They've met step 1 very easily. Step 2, during the kind of buying it, right? They go down a couple different weekends, or maybe they stay there for a week. And they work their butts off just to do some renovations, to clean, right? You got to furnish the place, right? As you know, Keith. So we're furnishing the place, we're doing all this work. And over the course of that year, within just that couple months, they are accumulating enough to meet one of the material participation tests. Okay. The person I'm thinking of specifically is using the 100 hours and more than anyone else test. Okay. So maybe they got, say, 150 hours in that short-term rental. Their next closest comparison person is maybe the cleaner, who maybe got 50 hours. Okay. Maybe they have a contractor handyman who also got 40 hours. You still win. Okay. Everyone else is less than you. You got more than 100 and it's the top. If you kind of think about a bar chart, you win. Right. And so that is why people love the short-term rental strategy compared to real estate professional status, where the bar is just so much higher. Okay. So that's why I like to focus on it. And that's why I think a lot of people, if we like real estate, we're okay having kind of a hospitality business. Okay. It's very different business than just a long-term fourplex, a long-term rental fourplex. Very different business. But at the end of the day, it provides the highest tax savings for the lowest amount of time in for busy people, either with full-time jobs, 2 full-time W-2 spouses, and or business owners, or those, who are just too busy to get 750 hours more than half their time. Okay. So for someone in my situation, it's the perfect strategy. I have not just used it yet. I'm getting there. But at the end of the day, it's great, and it's much simpler than real estate professional status. So I'll pause there. Any questions on that? Did that make sense?
No, it did make sense. And again, you brought up some really interesting pieces, because I've known folks that have gotten the property at the very end of the year as well, but they put it, quote, into service, but that basically is just putting it on Airbnb, not actually having the stays. So that's an interesting caveat to be able to add to it, that you definitely need to have the stays so you can get at least some kind of an average.
Yep. We see it a lot, unfortunately.
Yeah, I'm sure. Okay. And then what about, let's see, good enough from that standpoint. What other maybe real estate strategies are out there that people are unaware of? Obviously you've brought up quite a few of them that there's a lot of misconceptions on. So a lot of folks are going to be listening to this, even folks that are avid real estate investors, thinking, "Gosh, I haven't quite heard that spin yet." So I'm excited about this episode. I'm sure we're going to get lots of comments on it.
Yeah. Well, I'll tell you another one of my favorites, which is not necessarily only real estate specific. You could use this if you're a business owner as well. We simply call it shifting income to children. So obviously, it's only going to be relevant if you've got kids. I do, and so it's relevant to me and a lot of you out there. But I'll try to make this as simple as possible, and I will just tell you, this is one of those strategies that gets abused a lot because it sounds too easy. And I will just tell you, it requires so much documentation, and your kids actually have to work. Okay. It is so aggravating to me when I have people come to me and they're like, "Oh yeah, like I pay my kids, 12 grand a year." And I just like, what are they doing? And they're like, "They're models." Really? 12 grand a year for a model? Do you think another company is going to pay them for one photo? Right? No, it's kind of ridiculous, right? So whenever you hear, and just for your audience, whenever you hear something online, TikTok, LinkedIn, Twitter, X, whatever you're looking at, if it almost seems too good to be true, with essentially zero time and zero risk, it generally is not legit, right? There is something that it comes with. There's some difficulty. There's some additional risk. There's some additional documentation, whatever. Okay. So I just want to kind of caveat that for you. Your whole audience is a blanket statement because it's very frustrating when we see things that are just absolutely not true. So I'll make this short. Okay. Essentially, we're working under the Fair Labor Standards Act, which is essentially a child labor law. And it basically says kids who are under the age of 14 cannot go work. Okay. Can't go work for Target, Walmart, Chick-fil-A. Although my bit that I always say is I feel like people who work at Chick-fil-A are like 12 years old. I just don't know how they do it. They always look so young to me. But anyway, however, the 14-year-old kind of threshold essentially is gone. There's an exception there when a company is owned by a parent that hires their own child. Okay. So the 14-year-old limit goes away. Okay. And so what we've seen from court cases is now that age limit can really come to about 9 years old. Okay. That's kind of generally what we're comfortable kind of saying publicly, is that 9 years old, your child, your kids, anything above that could start to perform meaningful work. Okay. That's a key phrase that I like to pull out. Meaningful work within your business. And again, it doesn't have to be real estate. It could be your business. Okay. Just a normal operating business that you have. So with that, right, there's kind of a couple aspects to it. Number one is, what entity type are we paying them through? Is it an S Corp? Is it a C Corp? Is it an LLC? And I'll just say, to make it short, ideally it's like an LLC. If you're paying them through an S Corp, you're generally going to have to do payroll, and you're going to have FICA tax withheld. Okay, that's kind of the short of it, and there's a lot to expand on there. The second comment to make from a tax perspective is, if you pay your child less than the standard deduction, okay, again, this year I think it's like $14,600. Don't quote me on that. It's around there. Okay. If you pay your child less than that, well, they don't even need to file a tax return. Okay. Because imagine they do, they go to file it, they get the standard deduction, and it's nothing. Right? It's kind of, the IRS is like, this is a waste of paper. Okay. Just don't even send it in. So you pay them less than the standard deduction. Great. Now they're paying 0% federal income tax. Okay. Up to the standard deduction. That's great. Now, the third thing to say is that their wages need to be reasonable. What in the world does reasonable mean? It does not mean $12,000 for one picture. Yeah, that goes back to my example I was saying earlier.
Right.
But what that really means for, let's say it's a 9-year-old, okay, or you've got a 10-year-old, you are going to generally pay your 9-year-old, 10-year-old minimum wage, whatever that is in your state, in your county, in whatever. Right. So you go look that up. That's not a blanket statement. You got to go look up what that is. And you're going to pay them minimum wage by the hour. The other misconception and thing that doesn't make sense to us is when clients try to pay their kids a salary. and I will just tell them, are you telling me their wages, their time looks like this? It's just a flat 40, 45 hours a week? No, it's not. It kind of looks like this. It's almost nothing during the school year, and then it pops up in the summer for those 3 months that they're out of school, and then it drops off again when they go back to school, extracurriculars, sports, friends, things like that. So it doesn't generally make sense to do a salary. Okay, so we got to do by the hour minimum wage. Okay, but the next thing to say is their job responsibilities need to also be realistic. Okay, you cannot make your 9-year-old the CEO of your business. Okay, there's literally stuff like that out there. Okay, so please use common sense. Does this make sense? Would this really be reasonable to do this? Okay, if not, it doesn't pass the sniff test. Okay, all right, that's the context. Now let me get into really the 3 main benefits, how I like to summarize it. Benefit number 1 is that your business, okay, real estate or operating business, is going to receive additional deductions. How so? The wages that you pay your children, okay, children, whatever it is, that is just like a normal expense. Just like you hire another employee or you've got an independent contractor doing work for you, that's a deduction. Okay,
Right.
Great. That's now lowering our profit that we have to pay or furthering a loss. That's awesome. Benefit 2 is that your child could earn that income tax-free, right? If you pay them through an LLC, and if they are paid less than the standard deduction, that's 0% tax overall, right? So their income is going to be at 0%, while you are offsetting at, say, 37% if you're at the highest tax bracket. So if we even pause right there, just kind of 1 and 2 benefit here, that is a fantastic, amazing tax strategy because we have essentially increased the family's wealth. How? By paying less to the government, so now keeping more within the house. The part 2 is the dollars never left the home. They never left the roof, right? They never left the 4 walls. So the family's entire wealth has just increased, okay? And we've saved taxes, all of that kind of combined. That's awesome. But benefit 3 is actually one of my favorites in that we can take that earned income up to the IRA limit, $7,000 this year, and pump that into the child's Roth IRA. Okay? That is one of my favorite parts of the strategy because think about a Roth IRA. You pay the tax on the front end. Well, guess what? For that child, it's 0%. And then depending on how things come out and when and whatnot, that money could come out at 0%. It's like an HSA on steroids, right?
Yeah.
Very similar. Money goes in tax-free, right? If we follow some of these things, and it could potentially come out tax-free. Never paid money on that, okay? So business owners, real estate investors with children at that age who are willing to get involved, okay? I understand you've got some kids that are like, they're a teenager. They don't want to be involved. They just want to hang out with their kids and have fun. Okay, I get that. That's up to you and them. But for those of you who can, I have a lot of clients who have very ambitious children, and this is an absolute no-brainer for them, okay? And for some of you out there listening, you might say, how in the world, you're maybe like doing some numbers right now, and you're like, how in the world could I get to $14,000 to paying my child throughout the year? I'd say that's the wrong question. I would say the right question is, how can I get them to the Roth IRA limit? That's it, right? I want to just push everything I can into that. And everything else is kind of like, well, I can't sit it in a Roth IRA. You're just going to have it sit in a savings account. Okay, that's great. But again, the main benefit is actually getting it into the Roth IRA to grow tax-free.
Yeah.
Okay. So that is kind of the 1, 2, 3 for that strategy. One of my favorites to talk about publicly with friends, family, and so forth. So I'll stop there.
Yeah, no, that's great. And just if you could remind the audience, what is the Roth limit that you can contribute each year?
So last year, I think it was $6,500. Obviously, we're past that now. I think this year it's $7,000.
Okay.
In 2025 might be $7,500. I'm trying to remember, but that would be a quick Google search if you're interested in that.
Yeah. Either way, like you said, it's a lot easier number to obtain. As far as the child doing work. So, no, that's a great strategy. That's incredible. Something to think about. My kids are older now, but that would have definitely come in handy. So,
yep. And that's why this content and stuff is so valuable.
For
those of you who have younger kids, I've got a 1.5-year-old, going to turn 2 here in a couple months. I've got like 7 years kind of preparing and thinking about, what can I do now? That's a common question. Hey, my kids are 2 and 4, and what can I do? I always answer with like, go start to build business and rentals, and be thinking about how can I put them in and start to not, I'll use maybe a brainwash. You don't want to do that. But at the end of the day, you want to be thinking about how can I be getting them involved and interested, show mom and dad, what we're doing to provide for them. And, this is cool and whatnot. So be thinking about what space you can make, what responsibilities you could give them in the future, and start to pick up on, oh, my son is very interested in numbers. Maybe he could do the books, right? Maybe I could teach him to do that. Oh, I have a daughter who, loves doing the physical work, right? Like my wife is a very handy person. I'm generally not.
Right.
So it's like, you might be like, oh, my daughter would love to come and swing the hammer and fix things. And she's got really good spatial reasoning. So just be thinking about where they might fit in and start having early conversations to not only help them be set apart financially for the future, right? Because imagine your kids have a $50,000 Roth IRA by the time they're 18. Do you know the rest of their peers are going to be? Zero.
Yeah.
Okay?
Yeah.
That alone financially is going to set them apart. But not only that, now you've given them potentially 9 years of work experience. Do you know what that's going to translate to on either one, a resume, or number two, getting into the college they want to? It's going to be phenomenal. Okay. So there's these intangible experience and financial, tangible things where we can help our children for a long time. Okay. We got to be cautious of overwork and things like that. But yeah, fantastic strategy for those with kids at the right age.
How about anything else that maybe, I know we're running just a little bit long on time, but anything else that you want to mention with respect to, tax strategies? You mentioned LLCs, you mentioned S Corp, anything else from a entity structure that you want to mention to the audience?
Yeah, and because we're running long, I'll try to keep this part as just kind of a short little couple sentences. And so at the bottom line, if you want to even consider a little bit from a tax perspective, what would maybe a CPA think about entity structuring? I'll try to break it down this way. If you have rental properties, those of you listening, you probably have some, right? Just default to LLCs. Okay. Just want that to be the default. I use LLCs, not S Corps, not C Corps. Okay. If you have an attorney or another CPA recommending to you to put rental properties into an S Corp, please go get a second or a third opinion because that's generally not good. Okay.
Okay.
I could tell you stories for an hour on just that issue and what putting rental properties into an S Corp looks like, and it's crazy. But the second thing I'll say for those of you who maybe are business owners, you should strongly be considering a S Corp and or maybe just simply keeping it as an LLC. Okay. Then the common question then is, well, what about a C Corp? Generally, I would say C Corps are best for companies that you might sell and or like the whole intention of creating the business is to potentially sell or take public.
Okay.
That's kind of the simple way to think about the three categories from me as kind of a tax strategist. LLCs for rental properties, S Corp maybe for operating businesses, and then a C Corp if it's like, hey, I'm doing a startup, I'm going to take this thing public or I'm going to sell it. Okay. Those are kind of the three main categories that I would just kind of summarize our time with.
Yeah, appreciate that. This has been really good. You've opened my eyes to a lot of things. Now I've got to get some research done on some of the strategies that I've thought about using, and very, very incredible. Let me just ask if I could, how can people find out more about you if they want to connect with you, if they want to maybe use you to help strategize on their taxes?
Yeah, so you can kind of find me a lot on LinkedIn. Ryan Carriere, CPA. You'll probably see a headshot of me, or if you're watching this live, you'll see me. You'll also kind of know that I'm producing a lot of content on there every weekday that I work. So I post things daily, kind of real estate tax strategies. So go follow me, connect with me, send me a message on there if you're interested. I can kind of determine with you if we're a good mutual fit based on what you have going on, based on where you're at financially, rental properties, income, things like that. Otherwise, that probably is the best. I can't remember my URL that I should be using to give you, but maybe I can give that to Keith and he can put that in the show notes or something. But I'll just say start with LinkedIn and send me a message or comments on any of my things. And let me know that you'd like to reach out and we'll connect.
Yeah. One other question I have, maybe before I ask the two final questions I ask everybody, would be just any kind of, you mentioned kind of logging your time and keeping track of the time. Is there any specific program or anything you recommend on how to do that properly?
You could use any sort of time tracking app. I would say probably 90% of our clients simply use a spreadsheet.
Okay.
There's no magic behind it. It's literally just keeping track, finding what works for you. But yeah, usually spreadsheet, a few columns, something in G Drive, just kind of put it up there, put it in the cloud so that you can access that anywhere. Say you're at your property and you're, just getting in your car because you're leaving. Great. Pull it up in your phone, put in your information, and boom, off you go. You don't have to wait to get home and then you forget and all that stuff.
How about Ryan? Any advice you would give somebody who's maybe just starting out their investment journey?
I was gonna say, I know we talked about house hacking earlier, but I would say hands down, do a house hack.
Yeah.
Okay. In the world that we're in with the high interest rates, right? You can put down such a low down payment and actually get into real estate, right? That to me is like the starter place to do a house hack, right? It doesn't matter if it's a single family, duplex, triplex, fourplex. If you're like, I really want to get going into real estate investing, to me, that's the best. Okay. I wouldn't say, do stocks or REITs or anything like that. That's kind of something else. If you're really looking to have that control over the asset, get started in house hacking like I have, and like so many other people that I know also have. This is my third one that I'm in. We've got someone who lives downstairs. We rent upstairs. Again, this is my third. It's just so good to get in and to expand your portfolio. Hey, live there for a year, a couple of years, you move out. Great. Right now, take that and go buy the next one. And now you just kind of slowly accumulate rental properties over time doing that. So house hacking would be my short answer.
Yeah, that's really a good one, and I totally agree. Even from obviously you mentioned it allows you to be able to buy a property for that very little down payment, and you can once you've kind of outgrown that one, go to the next one. But it also just most people's biggest expense that they have is their housing, right? And so all of a sudden, if you've got somebody supplementing, even if they don't cover your entire monthly payment. But they take you having the ability to live in the place that you're, maybe would normally cost you $2,500 a month, and there maybe somebody's paying $1,000 off of that, so now you're down to only $1,500. I mean, it's just extra money in the bank, and just helps reduce that expense with the additional rent. How about a book recommendation, Ryan? Anything that you've read recently that's been impactful?
This hasn't been too recent, but I would say Rich Dad, Poor Dad. And maybe your audience, maybe you get that answer a lot. But just for me, my perspective, it was very foundational for me kind of understanding, real estate can kind of provide that cash flow that I'm looking for. Also, just it kind of breaking down the various like cash flow quadrants. I can't remember them offhand, investor, business owner, entrepreneur, employee, maybe that was it. But at the end of the day, just those kind of breaking down those really big kind of concepts was really helpful for me as far as how can I provide for my family and also kind of use various other sources, my extra money, right, investable money to help me kind of meet my financial goals. So Rich Dad, Poor Dad would be kind of foundational for me.
Ryan, really appreciate it. This has been a great show. And thank you so much for taking the time to be on the Wealth Flow.
Thanks. Yep. Thanks, Keith.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.